Okay, before we talk about transfer prices, I thought I'd just mention a little bit about goal congruence. And although it's nice to have independent divisions that operate like businesses and all that independence so that they can make their own decisions, you have to be careful that their goals and their personal ambition, okay, aligns with the larger organization. So like if you've got, let's say the snack division is doing extremely well, they may not accept a project, for example, that lowers their performance a little bit, even though it would be good for the rest of the company. Okay, so goal congruence is a big issue, and residual income is the one measure that can lead to better goal congruence than like just return on assets. Okay, because it has something to do with the relationship between how much is invested in a company and how much the company is earning. Okay, so read this piece in the book and then we'll talk about it a little bit more in class. Okay, and some of the measurement issues with those, all the different measures we looked at, is which date to use. Should we include all assets or exclude some? Should it be gross or net book value? Should we make other adjustments to income or assets? Should it be average assets? I mean, there are all kinds of different ways to do this, and I think what's important is that once you choose a method, for whatever your rationale is, don't change it, okay, to keep it steady. Okay. And the other limitations is a short-term focus, and that's a problem in this country. All right, that we don't think about organizations in long terms for long-term growth, or maybe for different social goods. So the remedy is that management can measure financial performance using a long time horizon and focus on the triple bottom line, where you're more looking at maybe non-financial measures of performance. Okay, strategies and mechanisms to determine a transfer price, and understand in the first place that this refers to, let's say, Frito-Lay buying packages from some packaging company within the same organization. Okay, so these are intra-organizational transactions. They're not outside of a company. But since these investment centers are treated like separate companies, they actually negotiate these prices. Now, transfer is a good definition here. Transfer pricing is the price charged for the internal sale of products between two different divisions of the same company. Okay? So that's two different divisions. Oops, I got the wrong thing. Oh, well, two different divisions of the same company. So it could become sales revenue to the selling company and a cost to the buying division. All right, so when these transactions take place, it affects operating income, return on investment, sales margin, and residual income. So companies are very sensitive to these prices, and you can spend a lot of time fighting about it, just waste a lot of time over negotiation of transfer prices. And the goal is to optimize overall profitability by encouraging a transfer price only if the company would benefit from the exchange. Okay, so what we're going to do is look at the outside price. If we can do it cheaper ourselves internally, then that's what we want to do. So the trick is to figure out the price we need to do that. Okay. So the selling division, this is like an important thing here to understand. The selling division wants the highest price possible, and the buying division wants the lowest price possible. Okay, so this is what's going to be the transfer price. Now the buying division is going to compare this price to whatever the market is charging. Okay, and the selling division is going to compare the price to what they could sell it for on the outside. Okay, so you want to optimize overall profitability by encouraging a transfer price only if the company would benefit from the exchange. Okay, so what should we do? What vertical integration is about is purchasing other companies within one supply chain to maximize the profits, because then you can set those transfer prices. Okay, and that's what vertical integration is about. Now, we've got three different prices to look at here. First of all, the market price. Okay, the market price, what's good about it is that it's fair. Okay, that's the external price. What's not so good is that it only can be used if there is an outside market, if you've got an external price. You know, it might be particular enough that you can't just buy this one part for a price. For an outside price that you can verify with the market. So what you think about though is that the market price could be reduced by any cost savings occurring from the internal sale by, say, some marketing costs. That's what you could do. All right, that's what's good about it. You could get rid of sales commissions and then say that's your price. A negotiated price allows division managers to act autonomously rather than being dictated a transfer price by top management. You'd like to try to avoid doing that, okay? But sometimes it's all you can do. But this takes time and effort. It may lead to friction, or it could lead to a better understanding between division managers. But there's a big investment here, and there's also risk. It may not work out. And considerations: the negotiated transfer price will generally fall between the variable cost, that will be the floor. All right, because the seller is not going to sell it for more. I mean, the person who's doing the manufacturing, okay, isn't going to sell it for less than their variable cost. That's cash out the door. All right, and the buyer is not going to buy it for more than market. So the actual price is going to be between the variable cost and the market price. Okay, or another way to do it is to use cost or cost plus a markup. And if there's not a market price, this is a good number. The selling division has no incentive to control costs. That's what's bad about it. They'll throw in their fixed costs, and a fair markup may be difficult to determine. What would be fair internally? Several definitions, what you've got to think about, several definitions of cost could be used, ranging from variable cost to full absorption cost. So full absorption is going to include all of your overhead. So you could have a variable cost and maybe add something to it. Okay, but you just have to negotiate in good faith. So a couple questions: do the divisions operate under if you're a multinational corporation, do the divisions operate under different taxing authorities? So the tax rates are higher for one division than the other. Okay, if that's the case, then we'll put the revenue side in the country with the lowest tax rate. Would the amount paid for customs and duties be impacted by the transfer price? Okay, so which way the goods are flowing. So all of these are other considerations that you add into your thought process in figuring out these prices. It's a very, very complex area. There's a lot of research done on this. So the next thing we'll do is look at flexible budgets, okay, and performance reports. And a flexible budget is where you change your quantity to what the actual quantity sold was. Then you're focusing more on what happened in the corporation. But when it comes to all of these topics, okay, throughout the chapter, we'll use our class time to work problems. Okay, so make sure that just get through these brief presentations first and get a concept for it. Hopefully read some of the book, and then when we sit down together to work, it'll be more meaningful to you. Okay.